Okay, so let's get started. So let's go back to the list. I think I'm displaying the list that we made at the start. So let's just have a quick check of how far have we covered. Let's just have a quick recap of how far have we covered. So let me just start the recording in the class group. So just a quick one on what we have covered so far. So here is the list of the standards, and we marked those that we said we want to start with, those that are related to assets. So we have IAS 2, IAS 16, IAS 20, IAS 23, IAS 36, 38, 40, 41, IFRS 5, and IFRS 16. So the good part about this, I think the bulky of those that we have marked, we've actually covered those. So let's now check which standards have we not done, so that we can do it today from those that we marked that are relating to assets. So IAS 2, we did talk about that. IAS 16, we did talk about IAS 16, accounting for property, plant, and equipment. We also did talk about IAS 20, how we account for the grants that we have received. So either it's a revenue grant or a capital grant. We also did look at the treatment of the grants as deferred income. So we can receive a grant. We can receive a grant and we treat it as deferred income. So I think we did look at that, and the recordings are there, so you can follow through if you have forgotten. Then we have IAS 23, borrowing costs, but I don't expect any of you to forget these things. You are supposed to be practicing these things in and out. Then also we did look at IAS 36, that is accounting for impairment loss. So we did cover how we account for impairment loss, impairment of assets. Then we also did look at, so we talked about indicators of impairment, allocating impairment to CGU. Then we also did talk about intangible non-current assets. Please, if you have forgotten any of these standards, please do revisit them, because it's very key that you do grasp every concept. Then we also did look at IFRS 5, assets held for sale and discontinued operations. So the conditions to classify an asset as held for sale, where you put the asset classified as held for sale, discontinued operations. We also talked about how you present these discontinued operations. Then we did talk about IAS 40, where we have investment property. That is property we have kept for rentals or for capital appreciation. We also did talk about the models, the fair value model or the cost model that you can use. We also did close with the biological asset, accounting for a biological asset. So please make sure you do revisit this, and please make sure you stay up to date. So I think from that list, the standard that we haven't covered that I feel we should introduce today is IFRS 16. So like I said, these standards are not going to be following the order of the list that I gave you, but I will be picking those that I feel are somehow connected, and those that I feel are crucial. After we've done those on the standards regarding assets, we are going to go through the key standards so that at least we can do the key ones. Then we will look at the other key standards we have not yet talked about, so that we can complete the most important ones first. Of course, all of them are important, but some are more important than others in terms of how they are examined. So we need to work on those that are crucial first so that you can have more time to work on them. So today we are going to look at IFRS 16, which is actually one of the standards I would put in the category of the important ones. So please make sure you do grasp IFRS 16. It's a standard that you're likely going to get in your exam. So one or the other, they can either in this first section, the middle section, or in the section C, you can get a question on leasing. So leasing can come as also additional information to the final account. So leasing of assets. So leasing of assets. This standard, it used to be, so this used to be IAS 17, I guess. So the standard was then further developed to IFRS 16. So what is it about? The standard is about teaching us or telling us how we should account for a lease. So if we enter into a lease agreement, there are two people that are involved in this type of an agreement. So in a lease agreement, just confirm my team whether you can see my screen. Just can you unmute and confirm if you can see my screen?
Yes, sir.
Okay. So IFRS 16 tells us how we should account for leases. So let's first of all understand what is a lease. So let's have a lease agreement. So what is a lease agreement? So if we have entered into a lease agreement, it is a contract which gives the right of use of an asset, a contract which gives the right of use of an asset for a period, for a period of time in exchange of rentals. So if it is a lease agreement, you are going to be using someone's property for a certain period of time in exchange for rent, or you can say in exchange for consideration. You are going to be paying. You are going to be paying to use someone's property. Then who is involved in this contract? So in a lease agreement, there are two parties involved. We have the lessee and the lessor, or the landlord. So there are two parties involved. The first one is the lessee. The lessee, this is the entity or person. We are, however, going to look at it in the case of a company. So this is the entity that is using the property, the entity that is using the property which does not belong to them. In return for rentals. So the lessee is you using the property that is not yours, while you're paying the rental. So a lessee is the user of the property, not necessarily the owner. So you can use the property while you are not the owner. So the lessee is the user of the property. Then we have the lessor. The lessor is the owner of the property. So these are some of the terms we're going to use regularly. So the lessor is the owner of the property. The lessee is the one using the property. The lessor is the owner of that property. So if we enter into a lease agreement, in this type of an agreement, you are going to be using the property that belongs to the lessor in return for rentals. So the key elements of a lease agreement. So for us to say this agreement is a lease agreement, there are key elements that must be in that agreement. So which are the elements? Let's give the heading elements of a lease contract. So the elements of a lease contract, which are these elements? So the elements of a lease contract, number one, there must be an identifiable asset. So for us to say we've entered into a lease contract, there must be an identifiable asset. Let me first of all list these elements, then we go into them one by one. So the first element is there must be an identifiable asset. The other element is the lease must be given, the lessee must be given the entitlement of the property must be given the, or maybe let's say the lessee must be given the entitlement of the economic benefits. Must be given entitlement of the economic benefits or substantial benefits. It can be all or substantial economic benefits. We'll look at each and every one of these. Substantially, so we say the lessee must be given entitlement of economic benefits or substantial economic benefits. Derived from the asset, derived from the use of the asset. The last one, we can say the lessee must be given the right to direct the use. Must be given the right to direct the use of the asset during the period. So the lessee must be given the right to direct the use of the asset during that particular period. So let's look at these. Let's expand this. So if we are saying the asset must be identifiable, so in a lease agreement, we must have an identifiable asset. We are saying if the landlord has a number of assets, if the landlord maybe is to give us a vehicle on a lease agreement, it should be specific. Which one have they given us? So identifiable asset, it means the asset must be separately, the asset must be separately distinguished from the other assets that the landlord or lessor has. So we should be able to tell which one is it. So it should be clear which asset has been leased. So it must be identified. So we should be able to identify, let's say, if there are 3 trucks that the lessor has. If we enter into an agreement, we should be able to tell. We can't just say it's an agreement to use the truck. Which one? Let it specify the asset that you are going to be leasing out. So we should be able to identify the asset. And the asset must not be substituted. They shouldn't say, okay, they've given you asset. Let's say if they have 3 vehicles. They can't say they've given you vehicle A. Then later on say, now we want to use that vehicle. Now can you take vehicle B? So we say if the asset is, if it's a lease agreement, then the asset must not be substituted. The asset must not be substituted. Unless the substitution is for the purposes of repair. So if you're saying the substitution is for the purposes of repair, we are saying that they can say, okay, the agreement says that the landlord is the one that is supposed to repair in the event that there is any problem. So the landlord can say, okay, since now there is a problem, you may use vehicle B while least I'm repairing vehicle A. So they can give you an alternative, provided that they're just making repairs to the one that is on the agreement. So it cannot be substituted merely because they want to use it, but it can be for the purposes of repair. Once the conditions are not met, then it means we might disqualify it from being a lease agreement. So for a lease agreement, it must meet these conditions. So the asset must be identified. Let's move on. Then also the lease must convey the benefits to the lessee. The lessee must be able to enjoy the economic benefits during that period. So transfer of the right to economic benefits, right to benefits. So we should be entitled to the benefits that are to arise during the period of the lease. So the landlord can't say that you are going to hire my truck. You are going to hire my truck, then for every order that you receive, I also need a share to that. So it means the lessor must give me the asset together with the benefits that are supposed to arise. So you can't say you've given me the asset, but the benefits that are going to arise belong to the landlord. So you should transfer substantially all the benefits or the bulky of the benefits. So the benefits arising during the lease period should accrue to the landlord, to the lessee. If it's a lease agreement, the benefits should then accrue to the lessee, not to the lessor. Then lastly, it should be the lessee who decides how to use the asset. You can't say it's a lease agreement. You're going to be using my vehicle, but I tell you where you go and where not to go. So if it's a lease agreement, then the lessee must be given the right to decide where to use the asset. So the lessor must seize control over the asset. So the lessee must be given the power to direct how the asset is going to be used. So there must be freedom of use. So C is saying the lessor must not intervene, must not tell the lessee when to use the asset and how. So if it's a lease agreement, directing the use of the asset must be given, the power to direct how to use the asset must be given to the lessee. So, however, in some lease agreements, it might, we might clarify. So for us to complete that contract, it must, the landlord might want to know how you're going to use the property. So once you have agreed on the use, then they can't come and tell you when to use that property. They can't come and tell you how to use. So of course, the lessee has to use the property in the manner agreed in the contract. But as to how, maybe the times when the assets are going to be used, where, if it's a truck, where to go with the load, that now should be in the hands of the lessee. Now, let's move on. The issue we are more concerned with is how then do we account for the lease? How then do we account for the lease? Now, let's look at accounting for the lease. So if the above conditions are not met, it might, we might not apply the provisions of IFRS 16. So if the asset is not identifiable, if the benefits have not been transferred to the lessee, if the owner or the lessor still intervenes in how the asset is to be used, then it may cease to qualify to become, to be treated as a lease agreement under IFRS 16. Now, let's move on. How do we account for the lease? If we are accounting for the lease, the lessee recognizes a right of use asset. recognizes a right of use asset and a lease liability. So the lessee recognizes a right of use asset and a lease liability. So let's talk about the two, the right of use asset. So the lessee is going to record the right of use asset and a lease liability. So let's start with the right of use asset. The right of use asset. So the right of use asset, you are using someone's property as the lessee. In your books, you record that as a non-current asset. But the non-current asset is the right of use asset. So this is accounted for as a non-current asset. This is recorded as a non-current asset. So the right of use asset will be a non-current asset. So this right of use asset, it is depreciated. It is depreciated over the shorter of the useful life of the asset and the lease term or lease period. So let's have an example to demonstrate that. So we can enter into a lease agreement. We can enter into a lease agreement. So the lease agreement, so ABC Limited entered into a lease agreement. To use KD Limited's building. To use KD Limited's building. The present value of the lease payment amounted to 40,000. Amounted to 40,000. The lease period is 10 years. The lease period is 10 years. But the building is expected to be useful for the next 8 years. So in this case, how are we going to account for the lease in the first year? So in the first year, I'll talk about the initial amount. Just a moment. So I'll talk about the initial amount to recognize. So the initial amount, it depends on a number of factors. So here we're just going to start with one of the factors, which is the lease liability. So the initial amount we are going to record. Maybe let me highlight that, then we finish the question later on. So the right of use asset, what is it that we initially record as the initial cost? Before we talk about it being depreciated, what is it that we initially record? So the initial amount to record in our books consists of what? So the initial amount that you're supposed to record, we consider how much are the payments that you are going to make in the life of this asset. How much of the payments in this lease period, how much are you going to pay? So we look at the payments you are going to make for the lease, or we can call that the lease liability. So we've entered into a lease agreement where we are going to be paying rentals. So we are going to calculate how much are the rentals we're expected to pay in the lease period. So that's the lease liability. Then we may also be required to make any advance fee payment. So we might be required to pay a deposit first. We might be required to pay any advance fee for us to be able to start using the property. So the initial amount also includes any extra fees paid above the rentals. So if we are required to make any additional payments above the rentals, that also constitutes the initial cost of the right of use asset, or the initial amount you record for the right of use asset. Any costs associated with the lease agreement, any direct cost of the lease. So any direct costs associated with the lease, maybe for us to enter into this lease agreement, there is need for the help of maybe a legal advisor. So those legal costs that we need to pay for us to enter into this lease agreement. So any direct costs for this particular lease, they are also included. Then at the end of the period, we might be told you need to dismantle some of the things you have put on the premises of the landlord. So any dismantling costs. So if there are any dismantling costs to be paid at the end of the lease period. So we are going to add up all these. We are going to add the lease liability. We add the extra fees that has to be paid. We add any direct costs that that is also associated to this lease. We also add if there are any dismantling costs at the end of the lease period. After adding all that, what we get is what we initially record as the right of use asset in the books. So this is the amount we are going to initially record. This is the amount you're going to initially record as the right of use asset. So this is the amount that I was saying. After you've initially recorded it as a non-current asset, you need to then depreciate it over the shorter of the lease period and the useful life. Now, looking at our example here, let's drag the example below here. So regarding the lease payments, we are only told the 40,000. We haven't been told of any other costs. So initially, on the date of the agreement, we are going to recognize the right of use asset. Of how much? We are initially going to recognize the right of use asset of 40,000. Then, during the year, the asset has to be depreciated. This right of use asset has to be depreciated. How are we going to depreciate this right of use asset? The right of use asset is depreciated over the shorter of the useful life. In this case, the useful life and the lease period. In this case, of course, the asset, we entered into a lease agreement for 10 years, but the asset is expected to be useful for 8 years. So we don't depreciate over 10 years, but we are going to depreciate over the shorter of the two. So it means the depreciation will be based on 8 years, not 10 years. The depreciation is to be based on 8 years, not 10 years. My team that I was also having audit and assurance with yesterday. So this is also an area to watch out for if you're doing audit and assurance, where there's a risk that they could depreciate using the lease period, while it is not the shorter. In most cases, of course, the lease period is the shorter, but there's a risk they can depreciate using the lease period while it's not the shorter of the two. So we deal with the shorter of the two. So it means the depreciation for the first year, it will be 40,000 spread over the shorter, which is 8 years. So that's 5,000. So that would be 35,000. So 35,000 would be the right of use asset. So 35,000 would be the amount for the right of use asset. Then we have talked about two things. We said in the books of the lessee, we are going to record the right of use asset. Then a lease liability. So the lease liability now, the lease liability, what constitutes the lease liability? So the lease liability. So for the lease liability, if you are recording the lease liability, it is the present value. Firstly, before we record it, what is it? It is the present value of what we are likely to pay. For the 10 years, we'll calculate, okay, we'll be paying 3,000 a year, making it maybe 30,000. But what is the present value of that 30,000? Yes, it would be 30,000 over the period of 10 years. But what is the present value of all those payments? So the lease liability, it is the present value of the lease payments. It is the present value of the lease payments that are to be paid. The present value of the lease payments that are to be made. So the payments for the lease consists of what? The lease payments consists of, we can have the fixed payments, so we can have the fixed payments. So we can be told that there are fixed payments that we have to make. This could be the fixed rent house that we are making for the fixed rent house that we make every month. Then also there can be termination penalty. So there can also be termination penalties. So if we have any penalties that we are likely to pay. So if there are termination penalties that we may be required to pay, we also include that in the lease liability. Then also we can have a residue guarantee. So a residue guarantee, we can enter into a lease agreement where the landlord tells you, okay, you can use my property. So my property, you can use my property for the next 10 years. Then when you give me back my property, it must have a minimum value. I'm giving you my property today. It has a value of 60,000. When you give me back my property, it should not have depreciated more than 50,000. If its value has fallen below that, you pay me. So if you give me my property when it's now have a value of 45,000, you pay me a 5,000 on top. So a residue guarantee, we can say this is a specified value that the landlord wants from the asset at the end of the period. So this is the specified value. So in a residue guarantee, or we can say if there is a residue guarantee, the lessee is required to pay the difference between the value, you can say the actual value in the market and the residual value, or the stated value. So we have agreed that you give me back the asset with a residual value we can place the value at 50,000. But you return the asset when its market value is now 45,000. It means how much is the residual guarantee? So these are still estimates. So you can estimate that the residual guarantee, because we are recording the lease liability, and now we don't know what would be the value maybe when we return the property, but you can estimate what is the residual guarantee. So it means the 5,000 is what we are going to pay. So that's what we would classify as being our residual guarantee. Now, let's move on. So the lease liability is split into current and non-current. So the lease liability is split into two components. That is the current and non-current liability. So the lease liability, we split it into current and non-current. So remember, the lease liability, we're looking at what we are going to pay. So the payments that have to be made, in the next 12 months, these are the current liabilities. So any lease payments that we are supposed to make in the next or within the next 12 months. So for the payments that the lessee has to make within the next 12 months, these are regarded as, so the payments that we have to make within the next 12 months, these are regarded as current liabilities. So current liability, this is a liability that you have to make, you have to settle within 12 months. Then for the lease liabilities that you can pay after 12 months, those are non-current. For the lease liability, that will be settled after 12 months. That is treated as non-current liability. So that will be treated as non-current liability. Then also, the treatment of the lease liability differs based on how the payments are being made. So let's say payments for the lease liability. payments for the lease. The lease payments can be made in advance or in arrears. So when we are paying, we can pay in advance or we can pay in arrears. So we have entered into the agreement where we are paying the rentals. So we can be told that the rentals are being paid in advance or in arrears. Please take note of that. That will affect your calculation of the lease liability. So if the payments, or we can say arrears, if the payments are made in arrears, they are made at the end of if the payments are made in arrears, they are made at the end of the year. So we use the property, then we pay at the end of the year. So the question can indicate that the payments are made in arrears, or they can give you the date. They can say we are paying, the agreement was entered into on 1 January, but we are paying in December. So if the payment is being made in December, it's after we have used the property. So it's in arrears. Then we can have the payment being made in advance. It means we have entered into the agreement. But, so let's have the payments in advance. So the payment in advance, it means we pay for the rentals for the year at the start of the period. This means the payments are made at the start of the period. So we actually make the payments at the start of the period. That's a payment in advance. So they can indicate that with the date, or they can say the first payment is made now. So if the payment is being made now, it means we are actually paying before the year. So on that date of the agreement, if the first payment is made on that date, it's a payment in advance because you are paying before we get to use the property. So are we together so far? Any questions? Hello, are we together?
Yes, sir.
Okay. Others, hopefully, we are also following. Okay, so now let's look at an example. Then we differentiate. Let's use an example to differentiate the treatment of the lease in advance and in arrears. So let's look at an example to show the difference in the treatment in advance and treatment in arrears. Okay, so let me just draft a question from my Okay, so we can say KD Limited KD Limited entered into a 5-year lease. Entered into a 5-year lease agreement on 1 November 20X2. Paying can say paying 10,000. Paying 10,000 per annum. Commencing 10,000 per annum, commencing 31 October 20X3. Commencing 31 October 20X3. The present value of the lease payments. The present value of the lease payments was 45,000. And the interest rate implicitly in the lease, the interest rate implicitly in the lease is 7%. The interest rate implicitly in the lease is 7%. What else may I need to add? Then the question can say determine the current liability. Current liability, non-current liability, non-current liability, the finance cost, or they can say the amount to be transferred to profit and loss. So the amount to be transferred to profit and loss and the right of use asset. At the end of the year. So from that statement, we want to derive quite a lot of things. So KD Limited entered into a 5-year lease. Take note of this. This is the lease period. So entered into a 5-year lease. This one is our lease period. So the lease is for 5 years. So it means the right of use asset is to be depreciated over either 5 years or its useful life. And the agreement is 1 November 2002. Paying. So may I ask, is this in advance or in arrears? Are the payments being made in advance or they are being paid in arrears?
Arrears.
Why are you saying arrears? Yes, Wilma, you said arrears. Why are you saying arrears?
Because they are starting to pay at the end of the year.
Okay. Are you all agreeing to that?
Yes, sir.
Yes, that's true. The payment is in arrears because it's being made. The agreement was entered into on 1 November, but the payments are being made at the end of the year. So it's a payment in arrears. That's the first thing to take note of, because the calculation will differ, especially for lease, for current liability. If you miss that, your current liability figure will be wrong, your non-current liability will be wrong, your amount that you transfer to profit and loss may be affected as well. So please take note of that step first, whether it's an advance payment or it's an arrears payment. Number two, the present value of the lease payments is 45,000. So the present value of the lease payment, we are saying the payments that you are going to make have been estimated to have a value of 45,000. So that's the initial value for the right of use asset. On the date of the agreement, our right of use asset we are going to recognize 45,000 as being the right of use asset. So the right of use asset would be 45,000. Then, since we are in a lease agreement for 5 years, the depreciation, can I just answer that? Hello? Yes, hello? It's okay, I'll check in the bottom lesson. So depreciation. So the depreciation would say then the 45,000. Spread that over the lease period. So it means for the first year, our right of use asset at the end of the year, it will be 36,000. That's the carrying amount of the right of use asset. Let's move on. So the question it requested that we calculate the right of use of asset is there. So we're done with that one. Let's move with the question. Okay, so the present value of the lease payment is 45,000. And the interest rate implicit in the lease is 7%. Determine the current liability, non-current liability, and the amount to be transferred to profit and loss. So now let's move to the next step, determining the lease liability. At the end of the year. Initially, yes, the lease liability, the present value is 45,000. But what about at the end of the year? So to determine the lease liability at the end of the year, we use an amortization schedule. So to calculate the lease liability, we use an amortization schedule, or we can say amortization table. So we use an amortization table. The amortization table differs basing on whether you are using the payments are in arrears or the payments are in advance. The right of use asset is not affected, but the lease liability will be affected. So if it's in arrears, how do we deal with the payment in arrears? Please pay attention. The table we use if it's in arrears, we start with the year, opening balance, interest, we have the balance, payment, and we have the closing balance. Okay, so the first year is, we can put the year 2003. So it was 2002 to 2003. So that's our year number one, 2002 to 2003. Was our year was starting November, ending in October. So our year is starting 2002, 2003. So the opening balance will be your lease liability. So this is your opening lease balance. It's 45,000. On the date of the agreement, you are expected to be paying 45,000. Then, if the payment is in arrears, we assume that the payment is after an interest component. So what happens is, if it's a lease, someone would charge you, if you are to calculate the rentals, for example, if it's for 10 years, if you calculate the price you would pay from the rentals for the 10 years, you'd realize that if you had maybe decided to save that money, you'd buy at a cheaper price than what you have been paying. So renting for a long time, it can actually end up being more expensive than buying it outright. But however, renting, it spreads the cost. So the landlord charges you an extra because you are paying in small installments. So the rentals, we assume there's an interest component. They will charge you an extra for the interest, because if you are to pay the rentals, you calculate the amount, you realize it's more than buying the asset itself. So the extra amount is the interest component. They are charging you because instead of getting the money once, they are getting the money in small installments, and the money has been spread over a long period. So there is an interest rate implicit in the lease, which is the 7%. So we then add that interest rate implicit in the lease. So the 45,000, we multiply it by the interest rate implicit in the lease. That is, so you multiply it by the 31, by the 7% together. Then you add up the two. So this is how you work out the schedule. You get your balance. Then the payment is the rental. At the end of the period, you are paying rentals of 10,000. So the payment is the rentals. So the closing balance is the opening balance next period. So the next period is 2003 to 2004. The next period is 2003 to 2004. So the closing balance becomes the opening balance. Then the interest rate is now 7% off. Then the new balance, you sum that up. Then you remove your payment, 10,000. Let's just round the amounts to whole number. So the closing balance is now 30. The sequence goes on and on and on and on like that. So for the first year, we're done, so there's no need for us to continue. So now let's go and identify the amounts that we want. So the question said that determine, from that we are required to determine how much is the current liability, the non-current liability, and also the amount to be taken to the income statement. So let's start with the non-current liability. So the balance next year, this balance for this year, the next year balance is the non-current liability. So we are in this period, 2002 to 2003. The closing balance for the next period is the non-current liability. It means that is a liability that you pay more than 12 months. So you record that as a non-current liability. So you record the 30,821 as a non-current liability. What about the current liability? Just a moment. Hello. It's fine. It's about WhatsApp and also check and so current liabilities. So the current liabilities, for the current liabilities, for the current liability, you compare the current year liability and the next year liability. So the closing balances are the liabilities. So for the current liability, we say the difference between the closing, this year's closing balance and the next year's closing balance. This year's closing balance and the next year's closing balance. Then what about in the income statement? Do you record 10,000 as a rent? No, you'll be paying 10,000 for lease rentals, but you don't record 10,000 as rent. You record the finance. You will record the expense, finance cost, expense of the interest. So what you record as an expense is the interest rate implicit in the lease, the 3150. So this is how you get the amounts you're going to record. Now we are going to repeat the same procedure. with only one adjustment, that the payments are being made now in advance. So we want to repeat the procedure with the payments being made in advance. So let me copy the question and we adjust. So this is the case where the payment is being made in advance. So if the payment is being made in advance, let's change maybe here. Commencing 1 November. So we've changed the dates now. The payment is being made now. Then take note of, let's say, the present value of the So if we are talking about the present value of the payments, or if it's in advance, they can say the present value of, let me explain it maybe in additional notes. The 45,000 then, they can give you the amount after the first payment, or they can give you before the first payment. So if the 45,000 is the present value of the future payment, it means the first payment has been made already. So if the 45,000 is the present value of the future payment, it means the first payment has been made already. But we are going to deal with the case where no payment has been made yet. I will then maybe give you a case of how do you deal with it if the first payment has already been made. So the 45,000 lease liability, we are assuming this is the payment we are supposed to make in total. So the table, we are going to take our table and make an adjustment to the columns. So that's why I was saying the table affects, because sorry, the arrears or advance affects the calculations because we're going to adjust the table. So the adjustment is we are going to exchange the interest with the payment. So if it's in advance, what start is the payment? So if it's in advance, what starts is the payment. So what starts is the payment. So the years are still the same. We can still copy the years. Then the opening balance, 45,000. We start with the payment now. If it's in advance, what starts is the payment. Then we have our balance, That's 45,000. Deduct the payment, then the interest. Our interest is still at 7%. So then we get our closing balance. Closing balance is the opening balance. We can just do this. Then the payments do not change. Then we get our balance. Interest rate 7%. Closing balance. So if it is a payment in advance, which one is our, so if the payment is in advance, what is our current liability, non-current liability, and the amount to take to the profit and loss? So let's start with the profit and loss. For profit and loss, the good part is no changes. So profit and loss, we still take the interest. So the profit and loss amount is still the interest rate implicit in the list, that's 24. But now we want the current and non-current liability. So the current liability is actually easy if it's in an advance. The current liability is simply the payment. The current liability is simply the payment that is to be made. So how much payment are we making? So we're not looking at the difference now. The current liability is the payment that we are going to make, the 10,000. Still, we can use the difference. We can still use that approach of the difference. So we are saying 37, but we are no longer comparing with this one. You compare with this amount here. So this amount here is now our non-current liability. So the non-current liability is no longer that last balance, but is the balance before the interest. So non-current liability. So our non-current liability is 27.4. That's our non-current liability. So you can still say 37,450 minus 27,450. It will give you the payment. So that is how we break down the profit and loss amount, the current liability, non-current liability, provided that the payment is being made in advance. So they can say the present value of the future payments is 45,000. A payment of 10,000, an initial lease payment of 10,000 is made on the date of the agreement. So the payment is in advance because the payment is made on the date of the agreement. But they are saying that the future lease payments are 45,000. So it means the opening balance, the 45,000, they are talking about the future payments, they are excluding the 10,000, of which the 45,000 we are starting with here is all the payments. So if the amount we have been given is not including the 10,000, it means our opening balance was supposed to be, so if it's the present value of the future, it means we are not looking at the payments we have made already. So opening balance for your table, you would say 45 plus 10. So it means you would start with 55. Because it means that we are looking at the payments you will make in the future, not the one that you've already made. So if they've just given you as the present value of the liability, yes, but if it's saying is the future payment, so it might exclude the payment which has been made now. So opening balance, we add the payment which we have made now so that the table can be able to work it out easily on the table. So I'm saying that watch out whether the 45,000 is including the payment we have already made or is excluding the payment. So the opening balance for our table, the one that we used, it was inclusive of the first payment. It's not only the payments we'll make later, but it's including the initial rent. Okay, so for our lesson today, I want to end here. Then we are going to finish up. There is on this standard, we are left with just discussing a short lease and sale and lease back transactions. So we will discuss this in the next session. So your task is to go into the kit. Can you please attempt questions on lease? I will finish up in the next session, then maybe look at IFRS 15, which is a very key standard, so that we cover the important ones first. So for today, thank you so much for your time. I don't know if there are any burning questions before we close.